All right, welcome back, guys. Welcome back to Crypto Insider. Today we're going to talk about market maker and order books. How does it work? If you like this content, please support me with a like and a subscription with the bell notification. It helps a little YouTuber like me. So we already covered the basics of the market, which was money versus assets, the price of money versus the price of assets. We covered fundamentals. We covered technicals. These you can all find in my first video, what you need to know about crypto before you invest. And we covered how market makers work with exchanges. What we didn't cover yet is the order book. So how does this work? How do market makers work inside of an order book? Well, there's always a pair inside of an order book, which is, for example, Bitcoin against US dollar, Ethereum against US dollar. It can also be crypto against crypto. So it can be Ethereum against Bitcoin, Ethereum against USDT. USDT is a stable coin. Those are also crypto coins. In essence, it's always a pair of two currencies, right? So how does this work? Let's go over an example. For example, we have the pair Bitcoin against US dollar, and we have two ways in crypto to buy crypto. We have two ways to buy cryptocurrencies. One can be through a decentralized exchange. One can be through a centralized exchange. Decentralized exchange works like this. It's, for example, Uniswap or SushiSwap or PancakeSwap or whatever swap there is. They work with automated market making, right? That's an automated market making concept, which runs a smart contract, for example, on Ethereum using ERC20 tokens, which are Ethereum-based blockchain tokens. And in this case, if we want to use Bitcoin, we need to wrap Bitcoin to make it into wrapped Bitcoin, which then becomes wrapped Bitcoin is a ERC20 token. And we use USDT. USDT can also be on Ethereum or it can be on other blockchains, right? So this pair gets staked into a liquidity pool, which means that people like you and me, we can stake our assets into the liquidity pool. And in return, we get an annual percentage yield, which is similar as how governmental bonds work. We get a reward every year, which comes in a percentage. We can also get rewards in governmental tokens, which could be, in this case, uni tokens. And we get a percentage of the fees, but that's already inside of the yield, right? So for example, I am the client, I come to Uniswap, I have USDT and I want to get wrapped Bitcoin, right? So there's a certain price for wrapped Bitcoin and I swap my USDT for wrapped Bitcoin. I swap it and I pay a fee. The fee goes to Uniswap and goes through the yield to the liquidity providers, aka the stakers, right? Now, the problem of this liquidity pool is that it needs to have a lot of tokens inside in order to make sure that there's less slippage, which means there's less volatility. So, which effectively means if, for example, there's only 10 wrapped Bitcoin in this pool against the equal amount of USDT, and I buy one I swap one rep Bitcoin, which is 10% of the whole liquidity pool, it means that the price will go, if I buy, for example, the price would go up. We could say the price go up by 10%. It's not really one-to-one how it works, but basically what you need to understand is that the more Bitcoin, wrapped Bitcoin is in this pool, the less the price is going to be affected by my swap. So if I want to swap my USDT for one Bitcoin and there's one rep Bitcoin and there is, for example, 1,000 rep Bitcoin, that's only 1,000th of the pool, which means there's less impact on the price. There's less volatility, there's less slippage. Now, if you want to understand how that works, I'll show you how it works on an order book, right? But for example, we can look at this rather wacky coin which has lots of low liquidity. And low liquidity can mean that if a lot of people buy, boom, crash down, right? So that happened with this Bitcoin Cash ABC. And you can see on the websites, for example, CoinGecko, that there is a lot of spread, like here, 21% and 2.5%, that's quite a lot. You want the spread to be less than 0.1. We'll get to what is the spread, but the depth is very important, right? So this basically means if I buy $19 of this Bitcoin Cash ABC, the price will go up by 2%. If I sell $682 worth of Bitcoin Cash ABC, the price will go down by 2%. This is depth. And depth, you can see it here as well. This is Binance Bitcoin USDT pair. And you can see that you have a buy wall and a sell wall, right? And this is what they call depth. So you can see here on the right, you can see how much Bitcoin, and on the bottom you see the price. So for example, if I sell 49 Bitcoin, it moves up and down. You can see it's very dynamic. Lots of bots going on in here. If I sell 50 Bitcoin, the price will go down by 0.7%, right? Which is a lot more liquidity. There's a lot less fluctuation in this Bitcoin market than there is in this Bitcoin Cash ABC, right? Because here, just $19 moves the price 2%. And here, if I sell 50 Bitcoin, it only moves the price by now even 0.7, 0.8%, right? So there's a lot less slippage or fluctuation inside of the Bitcoin market because there's a lot more capital inside, right? So this is also very important for institutional investors because if they buy a lot of Bitcoin, if they buy a lot of Ethereum, they need a liquid market to also sell their Bitcoin or Ethereum. Because if they sell, let's say, 1,000 Bitcoin and they end up selling it for, 80% less than what they bought it for, just because there's no one that wants to buy, there's no liquidity, there's no buy orders for them to fill their sell orders, they will have a problem, right? So this is why institutional investors, they usually opt for either Bitcoin or Ethereum because they are more liquid, there's more volume, there's more capital inside of these markets. All right, so back to this example. So we have here a liquidity pool that runs a smart contract, and this basically is all run by an algorithm, a formula that keeps this pool running. We want to have as many wrap Bitcoin and USDT inside this pool to make sure there's less volatility for this particular pair on, for example, Uniswap. All right, so how does a centralized exchange work? A centralized exchange works much differently. They work with an order book. An order book is what we just saw. Order book is here. Sell orders, buy orders, right? That's an order book. And yeah, so we have one side is buy, one side is sell. And here we see this thing that we just saw, is that here I have a buy wall, here we have a sell wall. In the middle, where the buyers and the sellers find each other in the market, this determines the price. And the difference between the highest bid and the lowest ask, this is ask bid, okay? I ask so much for my Bitcoin, I bid X amount for a Bitcoin, right? So, and the spread is basically this difference, right? Now, as you can see in Bitcoin, there's hardly any spread. You see that these lines are really touching each other. Well, who makes sure that they touch each other? It's the market maker. The market maker has spot bots. This is a spot market, spot BTC market. And what these bots do, they want to reduce the spread, reduce imbalances in the order book. Imbalances can be, for example, a lot of buyers and very little sellers, or a lot of sellers and just a very little buyers. And what these bots want to do, they want to fill as many orders, right? So price always wants to gravitate towards areas in the order book where there are a lot of orders. Whether there are a lot of sell orders or a lot of buy orders, doesn't really matter. The market maker makes money on the spread, the difference between a bid and an ask, on the market, right? So, for example, if a market maker jumps in between here and moves liquidity up here by basically placing extra buy orders here, now the spread is much thinner, right? And what they can do is they can, with algorithms, they can see whether they can jump in between this spread and make money out of it, which basically effectively means that they buy Bitcoin just a slightly bit cheaper than they will sell it for, let's say, a few minutes later, or an hour later, or 2 hours later. And in essence, it works like someone that runs a fruit store, right? You sell fruits, you sell apples, bananas, and oranges, right? And whenever you have a lot of inventory, you have a lot of fruits, you want to sell those fruits, right? But when you run out of inventory, you want to buy more. And where do you buy? Well, you could buy from the farmers that make these fruits, or you could buy from a warehouse, let's say, that buys from the farmers, right? But in essence, you need to understand as a market maker whether price going up creates more buy pressure or price going down creates more buy pressure. It sounds a bit weird because, you know, when you go to a store, you want to buy those fruits for as cheap as possible, right? You go to a fruit store, and if one fruit store, each apple costs $1, and the other fruit store costs 10 cents for an apple, you will go to the cheaper one. But in crypto, it works, and in the investment markets, it works actually the other way around, where when prices go up, people are more interested to buy a certain security, a certain stock, a certain cryptocurrency, because they believe that price will keep going up. So this is a really different psychology. The market maker wants to always buy as cheap as possible. They act like a normal consumer. They act like a normal businessman. But at the same time, they know that if they move price up, and move these buy orders and these buy walls up, so you get a big buy wall here, and sometimes you see this in an order book, and they withdraw these sell orders, because they run this order book. Don't be fooled, right? So this is their business. So now what you will see is that price will most likely end up here before it hits a resistance area here, right? Which means price moves up. And then you get to see this like big ass red, green candles. And that's exactly what most of you traders love to see, right? And it makes you excited. It makes you FOMO. You want to buy more. And this is the whole point that I made in my first video. So what do these spot bots want to do? They want to reduce spread, they want to reduce imbalances, they want to fill as many orders, and they want to move price to mess around with your psychology. And what is this psychology of the market? Well, look at the crypto fear and greed index. Right now, prices have dropped and everyone is extremely fearful, right? It's not like, oh, prices have dropped, everyone wants to buy, and it's like, okay, there's some people, they say, buy the dip, buy the dip, buy the dip, but the dip keeps on dipping, right? So at this point, we have extreme fear and we have less buyer interest right now than what we had back when we were above 60K last month. Look at this, greed, 74. Everyone was like, I'm getting rich, right? So this is very important to understand, that the market maker uses psychology, and the only point they have control over is the price, right? So, and that's, and that psychology they will use, right? So, that's very important to understand. Now, then the other point, and they have so much calculation to do, right? So, because they also have a futures and an options market, right? So, if a lot of people went long and they moved price up, they have to pay a lot of people, right? Because you have a contract with the market maker. But if they move price against you, the market maker gets paid, right? So, and then there's options as well, which I showed you the other day, where you can see what's going on in the options market, right? So the biggest options expiration is the end of the year, right? And you can see that here, open interest by expiration. See, 31st of December, there's the most options expiring. So it means the market maker can make most money here, or needs to pay most money here, because if all these people are right with their call, what they basically say, at 31st of December, Bitcoin is going to be at this price. If they are right, their contract will be triggered and they can buy, for example, Bitcoin at the price when they started this contract. For example, so when people say here, Bitcoin is going to go to 400,000, right? And they made this contract somewhere around 20,000, then they can effectively buy Bitcoin for 20,000 while it is at 400,000, right? And this this is all the market maker's job to fulfill his obligation of the contract. But if they are wrong, the contract is worthless, right? So they paid money for this contract. That's a certain, let's say, fee. And if they are wrong, they get nothing, right? So, and that money, that fee that they paid for the contract is basically in the pockets of the market maker, right? And so you have this max pain price, which means that this is the price where the market maker makes the most money, because most people that have these bullish calls, they are wrong, and the people that are very bearish and have very low puts, they're also wrong, right? Right now this is 48K, but this can change over time. And looking at this graph, I wouldn't be surprised if we end up somewhere, you know, if you look here, the volume is very low at these levels as well. So they can easily move price here, for example, to 30K. There's 280 million here at 36. So they definitely have flexibility to move price even lower, right? Because the only point is they don't want to move price like up here in this very bullish zone where everyone who wants Bitcoin to go, because then they have to pay a lot of money, right? So that's what the market maker all needs to put in his algorithm, and these bots will basically make sure that price goes to the point of most profit, right? So the futures and options bots, they will always hunt for profit, and they can see all orders. An order is you placing a buy order. An order is you placing a sell order. An order is your liquidation point. An order is your stop loss, right? So, you know, if a market maker needs more Bitcoin in his for liquidity, then, well, best thing to do for him is drop the price by a lot, hit everyone's stop loss, and take good profit on people's Bitcoin, right? Or liquidate everyone that went long. So this all happens in a huge calculation, and that is effectively what happens every day. And you have to understand that these markets are being forwarded every day to a new region of, let's say a new region of the world. So right now it's New York's time, like we're pre-market US, but we have the Asian markets, we have the European markets, and we have the Asian, European, and America, basically, right? So we can see that here. This is Sydney. Sydney has a market maker. Then we have Hong Kong has a market maker. And we have Tokyo. So Sydney, Tokyo, Hong Kong. Hong Kong is this green. Hey, let's see, we can even see it here. Yeah, here we go. Sydney, Tokyo, Hong Kong, EU Brinks, which is the first hour of trading in the European Union, basically. And in Europe, we have Frankfurt in Germany, and we have London. Let's see if we can see London. Yeah, here's London, right? So these all have market makers, and they actually work with each other to basically together make the most profit, right? And what you can see is here is they always work in a zone, right? So this is the low of today, this session, which Sydney set the low. Now here you see New York setting the high. Frankfurt, London, and New York setting a high here. and New York is now taking over. This is the pre-market New York, and this is the first hour of New York, right? And so all these guys work together to effectively make the most profit, right? And so they constantly, you know, when they give out the sessions towards each other, they say, well, for example, a lot of people, and this is not even the Bitcoin chart, but doesn't matter. It's just, this is actually the market cap of Bitcoin, which is fun. Okay, this is, effectively is just a Bitcoin chart. So, but let's say a lot of people during this morning, they went long here, right? Because prices were going up. Boom, they take price down, liquidate everyone, or hit their stop loss. Then let's say here a lot of people went short. Okay, boom, we put price up and we liquidate you all who went short, right? And I keep going like that. So they just look, where is the liquidity? Where can we hit those orders? And they're reckless. Like, they're not our enemies. They're actually very useful for us to make sure that we have a controlled market, or else everything would go up and down, up and down, up and down all the time, like really like crazy, like even more crazy like we have it right now. But we have to understand that there are people behind these charts that are constantly looking for orders, looking for profit, right? And so what we then have to think of, like in the terms of a big cycle, what I also said in my first video, go watch my first video, is that we, you know, as a hodler or as a trader, we always want to buy low. Like, this could also be a 1 hour or 1 day kind of thing. I mean, this is now a few years, right? Because it's a weekly chart, but this could be a daily chart as well. Like, I mean, it's not that different than what we just saw here, you know, it doesn't really matter, right? But you want to, if you want to go long, you want to go long on the lows of the session, and they want to cash out on the highs of the session, right? Or short on the highs of the sessions and go long and take profit on the lows, right? But we want to understand how the market maker prices, for example, in this case, Bitcoin. So ever since Binance had their USDT pair, and let's say the Binance market maker, well, we can see that they started here in 2017, just before the end of the bull run, right? And they accumulated here between the 3 and the 6K. Twice. First before the blow off top, secondly in the bottom of the bear market, and thirdly when we had the Corona dump, right? So this is a great level to buy Bitcoin, like perfect. You buy together with the market maker. 6 to 10K was a sort of a reaccumulation zone, was also accumulation, still a lot of accumulation going on, but also from this move, also a lot of distribution going on. But here, especially coming from the 2019 bull market, it started to become an accumulation, right? These levels slowly move up, right? What before was a distribution can after become an accumulation. Accumulation just means I buy a lot of coins as a market maker, and distribution means I sell a lot of coins, right? So, and then we have 10 to 20K, very interesting range as well, which was distribution here, which was distribution there, which kind of was a distribution and reaccumulation here before we shut up, right? So basically you could say the market maker had bought most of his coins here and here. Yeah. And what he's doing right now is he's, for the highest possible price, he's trying to sell them to you. I mean, that's the way it is, right? And no, most of you were not interested in Bitcoin back in March 2020. You were not interested in Bitcoin in June 2020. I'm talking about most people, maybe not you, but most people. But as soon as Bitcoin, this is what I mean with psychology of the market, as soon as Bitcoin start to become 30, 40, 50, Then suddenly everyone was like, hey, wow, I should actually get this Bitcoin, cryptocurrency coins, digital money, internet money. This sounds kind of cool because this is a way for me to get rich. So people want to see these moves first before they are convinced to buy. If I sell you a token that's still very low, you don't believe it's going to go up until you see it, and then you're already too late. So this whole point. So what I think is very interesting here is where we can see where these cycles might come down. What for me is a very interesting range is definitely the 20 and between the 20 and the 30K, because we basically skipped this whole range. We didn't consolidate it here. We didn't do nothing in here. Like there's nothing going on in this range other than just shooting straight up to 40K, right? So I think this could be a reaccumulation zone after we, let's say, ended this run. Maybe it's going to go further up, maybe it's going to go further down. We cannot say really yet. I do have more bias towards the downside at the moment than towards the upside, but I don't give financial advice. What I'm saying here, and what I said in my first video as well, is that you want to accumulate or buy at the lowest possible price. And you need to look at, okay, relatively to the market maker, well, where could he have bought, right? Which we just defined. So where would he start buying again? Well, if we start doing something like this, yeah, just an example, then obviously this is a great zone to buy, right? And this is different for every coin, obviously, right? So we can make a chart like this for every coin. I'm just doing it with Bitcoin right now just to show you how it works. So we skip this range, so it makes a lot of sense for them to come back to this range between 30 and 20K. Now, this was all distribution, right? And then we came down again for a short reaccumulation between the 30 and the 40K. And then we shot back up for a redistribution, right? It's a bit like Wyckoff distribution. A lot of people have been talking about it. You can look it up. For me, I don't really care too much about a Wyckoff scheme. I just want to see what the market maker is doing. And everyone expected a blow off top. So everyone expected it something like either Bitcoin doing something like this and then come down, right? Or here like this and then come down, right? But what actually happened is the market maker manages expectations of everyone. So he always tries to outsmart the market. Well, first, there was the half-yearly expirations here we just showed you, which was also a big one, was the end of June, right? So, boom, end of June, we were very low, so the market maker already made more money. He made a lot of money on liquidating all these longs here, right? And now he is, basically what he's doing is just working a double top. And he's trying to sell as much Bitcoin in his distribution zone between 40 and 60K before he goes to his reaccumulation zone. I'm not saying that this is going to be the reaccumulation zone. What I'm saying is that I'm interested in Bitcoin when it comes towards these price levels, and I'm interested to see whether we get there and you know what's going to happen. If we break the 50-day EMA here, which is this purple one, we could definitely come down to at least this zone, but I don't see any reason for the market maker to not come between 20 and 30K. Especially if you're telling me, yeah, because crypto is going to be this new thing and everyone wants to gonna get Bitcoin and all the banks are going to buy and everything. Everyone wants to buy in the future and it's going to be regulated and then everyone's going to invest and etc. etc. Well, Imagine you're the market maker. You run your fruit shop. You know that tomorrow or next week, a lot of people come to your fruit shop and they want to buy basically the whole store. What are you going to do? You're going to go get as much fruit as you can, right? Because you all want to sell that. So in that sense, it makes only sense for a market maker to bring price down if they expect a lot more interest in the market, because they need to bag up their bags. They need to bag up themselves, right? So, and they're allowed to do that. Like, they're allowed to go short on Bitcoin. They're allowed to go long on Bitcoin. They're allowed to buy Bitcoin. They're allowed to sell Bitcoin. The order book is their territory. This is their game. You come to their house, their game. So you have to understand what these guys are after, or else you're always left guessing, and you're always depressed that price moves against you. Yeah, of course it moves against you. Like, is it a wise idea to use a stop loss? Like, so many traders will tell you, and trading websites and pro traders to say, yeah, you need a stop loss and this and that and blah, blah, blah. Of course, it's not a good idea to make a stop loss. It's my point of view. I'm not saying it's the right point of view. It's my point of view, because a market maker wants to fill as many orders as possible. If he sees your beautiful stop loss and he sold you Bitcoin for 60K and now your stop loss is at 40K, yeah, that's fucking profit for the market maker, right? So of course he wants to hit your stop loss. Of course you're going to be stopped out of your long trade, short trade, whatever, right? So there's much more to understand before you can become somewhat a decent trader. Why do you think all these YouTubers have all these exchange references? You can sign up here and you can sign up there. Because market makers and exchanges, they work together, one. Two, newbie traders that watch YouTube, yeah, they don't understand these things, okay? They do not understand these things. So they are easy prey for market maker that works with algorithms, bots, and has this whole system. You cannot win from the system, okay? You can make money on these markets, of course, yeah? You can even be a good leverage trader, but you want to be on the side of the market maker. You want to know, oh, does the market maker want to move price down now, or do they want to move price up now? Do they have incentive to move price up, or do they have incentive to move price down? All right? Okay, this is why order books are important. So, that's it for today, guys. I think this, for most of you, was helpful, I hope. If it was so, then please hit that like and subscribe button. Send this to your friends who got wrecked on all these leverage trades and who got stop losses hit and whatnot. I'm not saying a stop loss is always a bad idea. I think a stop loss is a good idea if you put it in profit. So at least when you get stopped out, you're still stopped out in profit. And what I think also is a very good idea is to always keep monitoring your trades. Like, don't go to sleep and then just leave your trade open, because next day you wake up and you're liquidated, right? So you need to be on top of your stuff, and you need to try to understand what is the market maker up to. It's not a bad person. It's just people that make money, want to make money like you and me. And you need to check what are their incentives, what are their data points, and where do they want to move price. Do they want to move price to 400K before the end of the year? I don't think so. There's not a lot of 100% sures in this market, but Bitcoin's not going to hit 100 or 400K at the end of the year. That I could most likely say for 100% sure, and just because of the basis of this information here, right? So make sure you have the information to yourself, and make sure you study all of this. Make sure to watch my first video. And with that, guys, I wish you all the best with trading. Tomorrow is going to be a big day already. Like I said, we're going to look at what the central bank, the Federal Reserve, has for us. So that's it for now, guys. Hope you enjoyed it. Hit the like and subscribe button, the bell notification, and see you tomorrow for a very, very big day. Ciao.